Okay, chapter 8, our last chapter. So we are focusing on something called closing entries for a service business. So we are at the end of our accounting cycle, essentially. We have looked at transactions, we have analyzed them, we have then journalized them, we have then posted them, we have then moved all of our financial information over to a worksheet, and then we created financial statements. And so now we are at the very end. And what we are going to have to do is close out what are called our temporary accounts so that we can prepare for our next accounting cycle, our next accounting period, the next fiscal period for that business. So as a review, in your notes here, it talks about adjusting entries, which we did back in chapter 6, and how we record them and how we journalize them, because you might get adjusting entry information pop up again in chapter 8. And that's because it leads us in to what are called closing entries. So closing entries are going to deal with permanent accounts and temporary accounts. So permanent accounts are also referred to as real accounts, and they are never going to close. They're going to accumulate information from one fiscal period to the next. Our permanent accounts are going to be all of our assets, all of our liability accounts, and then our owner's capital account specifically. The ending balances of these accounts are going to be the beginning balances for our next accounting cycle. Our temporary accounts are only accumulating information until we close them into our capital account. These are referred to as nominal accounts. And that is going to be all of our revenue and expense accounts, our owner's drawing account, and then finally, the income summary account is going to be used in this chapter. All of the changes from these accounts are going to be reflected in our owner's capital account, because that is a real account. It's permanent. It's not closing. These accounts we're going to end up closing, zeroing out, so that we can start the balances of the next year as 0. So the entries used to prepare the closing of temporary accounts are closing entries. And those are we're going to end up closing all those temporary accounts into a permanent account, which is going to end up being capital in the end. Income summary is a temporary account that's going to be used when we are closing our revenue and expense accounts. It does not have a normal balance side because it depends on if we had a net income or a net loss, on if it is getting a credit balance or a debit balance. So the steps for closing entries, which we're going to do in MindTap, so please read through these notes. But the first one is we're going to close all of our income statement accounts with our credit balance, which is going to be our sales account. So what we end up doing is we close sales into income summary. In order to close sales, we have to do the opposite. So sales normally has a credit balance here. To close it, we're going to debit sales, which will zero that account out and close that amount into income summary. So income summary now has a $3,565 balance. Next, we're going to close all our income statement accounts with debit balance, which are all of our expense accounts. So all of our expense accounts normally have debit balances. To close them, we are going to have to credit all of those expense accounts, which will end up zeroing them out. We're going to add the total of our expenses up and close them into income summary. So now income summary got a debit of the total of our expense accounts. Next, we're going to close income summary because it's been used to summarize our sales and our expenses. And we're going to close that directly into capital. So we started with a credit from our sales. We added a debit in for our expenses. That's going to be the same number as either net income or net loss. So depending on what the balance is, we're going to do the opposite. And since in this case, it's a net income, to close income summary, we would get a debit, which would increase our capital count with a credit. So net income always increases owner's capital, which results in a credit to capital and a debit to income summary. If we have a net loss, that's going to decrease owner's capital, which is going to result in a debit to capital and a credit to income summary. The last account we have to close is our owner's drawing account because it is also a temporary account. So to close owner's drawing, we do the exact opposite because owner's drawing is decreasing the amount of owner's equity. It's neither a revenue nor an expense account, so it's not closed through income summary. It's just closed directly into capital. So normally capital has a credit balance, drawing has a debit balance. In order to close it, we have to do the opposite. So drawing is going to get a credit here and capital is going to get our debit. Okay, let's go to MindTap and perform these entries. Okay, so first we're going to journalize the entries. So our first one is going to be closing out. Oh, sorry. We are Fix It Now, and we are April 30th, and we are performing all the closing entries for our account. So our first one is going to be the 30th. We always close our sales account first. Sales has a normal credit balance. So we are going to debit sales, 2,160. And we're going to close it into income summary, 2,160. There is no source document because we're pulling this information straight from our worksheet. All right, next we're going to close all of our expense accounts. So there's all of our expense accounts. They're going to end up getting credit. So our first account here is going to be income summary. And we're going to come back and put the debit total in. But then we're going to list all of our expense accounts. So advertising expense, it's getting a credit of 460. Next was our cash short and over. And it is going to get a credit of $6. Next is insurance expense. And it is getting a credit of 125. Then we have miscellaneous expense. It is getting a credit of 189. Supplies expense. It is getting a credit of 153. And then our last one is utilities expense for $550. Okay, if I add up all my expense accounts here, that's going to be the total that's coming to income summary. If you want to save yourself some time, you've already done that addition, and it is right there, 1,483. So that is what we are closing in to income summary. All right, next we have to close income summary. So 30. Income summary. This is where we got to determine, did we have a net income or net loss? If we had a net income, then income summary is going to get a debit. If we had a net loss, income summary is going to get a credit. In this case, we had a net income of $677. Income summary, 677. And I'm closing it directly into capital, which if I don't know whose capital account, it's right here. Connor Whitney Capital, $677. The last account I need to close is the owner's drawing account. And we got to do the opposite. So Connor Whitney Capital and then Connor Whitney Drawing. And I just need to go up here and find my drawing account, 1,700. And that's going to be a debit to capital because it's decreasing it, and a credit to drawing so that it closes it. Last step, we just need to go through and post all of these accounts. So sales, 30th, journal page 8. Our credit amount, 2,160. Sorry, that's a debit, 2,160. We're doing exactly what happened. That's going to zero out our balance. account number 410. Next, income summary is getting a credit of 2,160. April 30th. Post ref. Page 8. And it is getting a credit of 2,160. It's going to create our balance, 2,160. 330 is our account number. Next, we're giving a debit back to income summary, 1483. 30th, page 8, 1483. That's going to bring our credit balance down because we're going to subtract that. 677 is our new balance there. Plug our account number in. Now we need to do all of our expense accounts. We're closing them. So advertising expenses first. 30th, page 8. It had a credit of 460, which is going to zero those out. Take my account number 510. Next, cash short and over. 30th, page 8. It had a credit of $6, which will zero those out. Account number 520. Insurance expense, 30th, page 8. Credit of 125, which is going to zero that out. 530. Miscellaneous expense, 30th, page 8. Credit of 189. Zero that account out. 540. Supplies expense, April 30th, page 8. Credit of 153. Zero that account out. 550. Utilities expense, last one, 30th, page 8. Credit of 550, and it's going to zero those out and plug in my account number. All right, next I'm going to close income summary. 30th. Oops, not 40. Page 8. Right now I have a balance of 677. So I'm going to give it a debit of 677, which if I don't know, that's exactly what I did here. That's going to zero my account out. 330. And I'm going to go add that to my capital account. 30th, page 8. I gave it a credit of 677. And that's going to increase my balance. So if I add those two together, my new balance is 8,120. Plug in my account number. Next, I'm closing drawing, which is going to decrease my capital account number or capital account balance. Page 8. It's getting a debit of 1,700. Which is going to bring my credit balance down. I'm going to subtract that. So my new balance is 6,420. Plug in my account number. And then finally is drawing. April 30th, 8. It's getting a credit of 1,700, which is going to zero that account out. And my account number is 320. All right, don't forget to do the on your own and terms.